Hello everyone, we are Group 1. My name is Agnes. Here with my teammates Azani and Delima, we are going to discuss about expenses, topic 9 of financial accounting subject. For this presentation, we're going to discuss expense definition, expense recognition, expense measurement, opportunistic behavior, and last but not least is the case solution.
So I'll be explaining the definition of expenses, which came from framework and KKPK, kerangka konseptual pelaporan keuangan. So in framework, expenses are defined as decreases in economic benefit during accounting period in the forms of outflows or depletions of assets or incurrences of liabilities that results in decreases in equity other than those relating to distributions to equity participants. Expenses also encompasses losses the same way with expenses that arise in ordinary activities, not regarded as a separate element. And framework also define that physical activity must be associated in order to define operational expenses. From KKPK, expenses are defined as decreases in assets and increases in liabilities, resulting in a decrease in equity other than those relating to the distributions to holders of equity claims. Expenses are also elements of financial statements that relate to the financial performance of the entity, where users of financial statements need the information about the entity's financial position and financial performance. Next, we have changes in asset and liability. Under framework, revenues and expenses are directly related to the value aspects of assets and liabilities, and also refers to the outflows and depletions of assets on or insurance of liabilities, while in KKPK, information provided about the asset or liability and about any related revenues and expenses must be relevant. And in here, the information provided about the asset or liability and about any income and related expenses must be faithfully representing the substance of the transactions or other events from which they have arisen. And then next we have expenses and costs. So usage of asset entails cost to the entity, which is considered as expense, where if the company has no cost means they have no expense. For example, an employee renders services without pay, perhaps in order to gain experience. So certainly the company should not record any wages expense. And expense is also sometimes referred to as an expired cost. Next, I'll be explaining about the recognition of expense under framework and KKPK. So, under framework, expense is recognized when there is a probability that any future economic benefit associated with the item will flow to or from the item. And then the item should have cost or value that can be measured with reliability, in which estimates are required, for example depreciation expense, provision for doubtful debts, but appropriate evidence must be available to support the validity of the estimates that is necessary. It shouldn't also create bias in the information reported, and there should be a prudence and neutrality. In here, prudence means the inclusion of a degree of caution in the exercise of judgments needed in the making of the estimates required under conditions of uncertainty, such as that assets or income are not overstated and liabilities or expenses are not understated. So in KKPK, the entity makes expenditure that may provide evidence that the entity has sought future economic benefits, but does not provide conclusive evidence that the entity has acquired the asset. Recognition of expenses occurs at the same time as the initial recognition of liability and an increase in the carrying amount of the liability. And it also recognizes when the occurrence of the recognition of asset happen or a decrease in the carrying amount of asset.
In this part, I'm going to explain to you regarding the measurement in expenses. approach in measuring expenses is allocation of expense. Allocation of expense means that we allocate the expense to the period which they are related to. This is based on the matching concept of accrual accounting for the cost incurred. The matching concept is important in historical cost accounting because it helps accountants to decide which costs should be expensed and matched against the revenue for the period, and which costs remain unexpired to be recorded in balance sheet. There are three basic methods of matching that are commonly used or carried out to overcome the problems with determining and measuring costs to be expensed and to be carried forward. They are associating cause and effect, systematic rational allocation, and immediate recognition. Associating cause and effect means that we match the expenses allocation by doing a reasonable observation on the expenses, since many expenses are linked to the revenue they help to produce, although it is a hard process and difficult to go through. Next is systematic and rational allocation. When there are no clear links between expenses and revenue, we use the systematic and rational allocation. Some expenses are affecting many periods or expire over time. For example, since it is hard to determine how much expenses attributable to an asset in particular period, let's say a machine, it is best to spread a portion of the total expenses allocation throughout the useful life of the machine. This is called depreciation. The last but not least is the method of immediate recognition. This method is used when there are no particular links between the expense and revenue produced by the expense and the future economic benefit cannot be determined. For example, advertising expense. The current practices of allocation is criticized because the allocation of accounting information do not meet these criteria as mentioned by Thomas. First is additivity. Additivity means that the whole must equal the parts. In this essence, if an allocation is made of a total, the partitioning of it must exhaust the total. When the allocated amounts are added together, the total is the same as before the allocation. And the second one is ambiguity. Ambiguity means that an allocation method should yield a unique allocation where a choice of the method should be made. And the third one is defensibility. When the allocation method is selected, the person making the selection must be able to provide conclusive argument of their choice and defend it against other possible alternative methods. However, in defense of allocation, the criticism mentioned by Thomas can be argued that the objective of allocation could be changed depending on the existence of a unique and identifiable cause and effect relationship between the cost
about intangible assets. So first, opportunistic behavior might happen because expense requires a lot of elements of estimates. For example, in depreciation or amortization expense methodologies, it includes estimate of useful life and also salvage value, in which salvage value is the expected amount to be received by a company after the asset's useful life, or the expected amount that the asset can be sold at the end of its useful life. And next is warranty expense. And the estimate includes the number of products sold that will be claimed for defects. And it must be estimated when the revenue for the product sold is often classified as intangible asset, and also research expense, which is also often classified as intangible asset, while in fact, according to IAS 38, both advertising and promotional costs, as well as research costs, cannot be capitalized as intangible asset and must be expensed. And also, companies often make internally generated goodwill, such as brands, publishing titles, mastheads, and also customer lists, and items similar to the nature as intangible asset, while in fact, according to IAS 38, these items cannot be classified as intangible asset. And the opportunistic behavior is to inflate asset because it can attract investors in terms of company valuation when the investor use asset-based valuation. And also it can attract lenders in terms of debt to equity ratio and collateral, because more assets means that the company can use more parts of its asset as collateral for getting more debt or funding. As mentioned before, one of the areas of expense where opportunistic behavior often happens is employee benefit. Employee benefit is regulated in IAS 19 and also PSAK 24, and it requires company to recognize liability when an employee has provided service in exchange for employee benefits to be paid in the future, and also to recognize expense when the entity has consumed the economic benefit from the service rendered by the employee in exchange for employee benefit. So this is basically the matching principle, in which when the service is rendered to the employer in a period, then in that period, employer must recognize expense, which is the benefit or the salary. And classification of employee benefit according to IAS 19 and also PESAK 24 is short-term benefit, post-employment benefit, other long-term employee benefit, and also termination benefits. First is the short-term employee benefit, which is an employee benefit that is expected to be settled within the 12 months in which employees render their service, and it is recognized as an expense included in the profit or loss as an discounted basis. And the examples are wages and salaries, as well as social security contributions, paid annual leave and paid sick leave, profit sharing and bonuses, and non-monetary benefits such as medical care, housing, cars, and free or subsidized goods to current employees. The journal is debit to expense and credit to accrued expense or liability, or cash when it is paid. An important note, however, is the nature and definition of short-term paid absences and also profit sharing and bonuses. So short-term paid expenses in this case, in the case of accumulating paid absences, the expected cost of short-term paid expenses must be recognized when the employees render the service that increases their entitlement to future paid absences. Meanwhile, in the case of non-accumulating method, the company must recognize when the absences occur, and also profit sharing and bonuses. So the expected cost of profit sharing and bonus payment shall be recognized when the entity has a present legal or constructive obligation to make such payments as a result of past events, and when a reliable estimate of the obligation can be made. So in this case, due to the nature which involves expected cost, future entitlement, and also estimate, there can arise some opportunistic behavior which can either drive down the expense or increase the expense according to what the company wants. Next is the post-employment benefit, which is employee benefit that is payable after the employment ends. It is categorized into two, which is defined benefit plan, and which employment has the obligation to pay a specified amount of benefits to employees according to the plan, and the investment and risk falls on the employer. Meanwhile, the second category is the defined contribution plan, in which employer pays a fixed amount of contributions into a separate entity, which is a fund, and will have no further obligation if the fund does not hold sufficient assets, and the investment and risk thus fall on the employee. So accounting for defined contribution plan is straightforward: debit to expense and credit to accrued expense or liability, or cash when it is paid. So the opportunistic behavior often happens in the defined benefit plan because it requires a lot of actuarial estimates, such as estimated lifespan, estimated period of employment, and also expected pay level in the future years. So components of defined benefit expense includes 5 components, in which 4 of it is included in the income statement, while 1 of it is included in other comprehensive income. So first is the current service cost, which is the actual present value of benefit costs incurred in the year, and this increases the PVDBO, or present value of defined benefit obligation. Second is the past service cost, which is the amount of compensation for past service rendered by the employee due to changes in benefit plan, and this also increases the defined benefit expense. And next is the net interest from defined benefit liability or asset. This can be net interest expense or net interest revenue. If it's expense, it increases the defined benefit expense. If it's revenue, then it decreases the defined benefit expense. So it uses a discount rate rate, which is the rate chosen by the company, used to also calculate the PVDBO, and it usually reserves paid absences such as long service or sabbatical leave, jubilee or other long service benefits, long-term disability benefit, profit sharing and bonuses, as well as deferred remuneration. The journaling is akin to the previous expenses, which is debit to expense and credit to accrued expense or liability or cash when it is paid. And lastly is termination benefit, which is employee benefit provided in exchange for termination of employment. So the example is compensation for closing a segment, thus the company lays off some workers, and the accounting or journaling treatment is also the same as previous expenses. However, note when termination benefit is expected to be settled wholly before 12 months, then the recognition applies the requirement for short-term employee benefit, which is on discounted basis. Meanwhile, when it is expected to be settled wholly, not within the 12 months of the period, then it is applied the requirements for other long-term benefits, which is using the discounted basis. Again, there is possibility of opportunistic behavior to the nature of using discounted basis, as in according to FRC or Financial Reporting Council, choosing discount rate is one of a form of estimation which can be manipulated to drive down expense or inflate expense. Next, I'm going to talk about IAS 38 about intangible assets because as I've mentioned before, sometimes company intentionally misclassify expense as intangible asset, while in fact the definition of intangible asset itself is an identifiable non-monetary asset without physical substance that must meet three definition criteria. The first one is identifiability, which means that the asset is capable of being separated and sold, transferred, licensed, rented, or exchanged, or the asset arises from past events which is legal and contractual rights. And next, there must be control, or the entity has power to obtain benefits from the assets. And next is future economic benefit, which means that the entity expects revenue or reduce future costs from having the assets. And also, the company can only recognize the asset as intangible asset if it meets the definition criteria and also the recognition criteria. The recognition criteria is that it is highly likely that the future economic benefit will happen or flow into the entity, or the probability of the future economic benefit is more than 50%. And also the cost of the tangible asset can be measured reliably. However, IAS 38 notes that the probability recognition criteria is always satisfied for intangible assets that are acquired separately or acquired through business combination. So, if the definition and recognition criteria stipulated in IAS 38 are not met, then the item must be included as expenses. So the examples of intangible assets includes trademarks, patents, franchise, and also copyrights, and also others such as customers list, mortgage service rights, licensing, royalty and standstill agreement, import quotas, customer and supplier relationships, including customer list, and marketing rights. However, there are certain things that the company must be aware of. First, in terms of research and development, in which according to IAS 38, research cannot be included as intangible asset but must be expense, while development can be included as intangible assets. However, if the company purchase or acquire the intangible asset through business combination, then both R&D can be included as intangible asset. Next is internally generated brands, mastheads, titles, and lists, which cannot be recognized as intangible assets. Next is internally generated computer software, which cannot be recognized as intangible assets and must be expensed and amortized along its useful life. However, when the technological feasibility, probability of future benefits, intent and ability to use or sell the software, resources to complete the software, and also the reliability to measure the cost is met, then the internally generated computer software can be turned into intangible asset. Next is certain costs, such as internally generated goodwill, startup, pre-opening and pre-operating costs, training costs, advertising and promotional costs, including mail order catalogs, and relocation costs, must be charged to expense when incurred and not as intangible assets. So the example of opportunistic behavior can be seen in the case in which I will also explain the case solution based on IAS 38. So according to the case, it can be seen that Max Ltd is an Australian mail order company that has substantial net income in the past years. However, there are some accounting treatments that are questionable, which makes them very successful. First, Max Ltd capitalizes the cost of its direct mailings to prospective customers, which is $4.2 million at 30th June 2021, and amortizes them on a straight-line basis over 3 years. So this is questionable because there is no guarantee that customers will be obtained and retained from the direct mailings. Next, Max Ltd purchased a customer list from a competitor for $800,000 on 4th of July 2022. This list is recognized as a non-current asset, and Max Ltd estimates that this will generate sales for at least another 2 years and more likely 3 years. The company also plans to add names obtained from a phone survey conducted in August 2022 to the list. These extra names are expected to extend the list's useful life by another year. So, a Max Ltd 2021 statement of financial position reported $7.5 million of marketing costs as non-current assets. The question is to explain how Max Ltd costs should be accounted for under IAS 38 intangible assets. So first, I'm going to answer based on the direct mailing cost that the company incurs. So according to the case, Max Ltd kept it as intangible asset because it meets the 5 criteria of the definition and recognition criteria. First, the identifiable or passive event criteria is met because it is purchased, meaning that it can be separated and sold. Proof is the competitor is able to separate it, list it, and sell it to Max Ltd. Next is the control criteria, which is met because Max Ltd as the buyer does not have any factors hindering them from using the list and obtaining the benefit from it. Third is the future economic benefit, which is met because if Max Ltd does not expect any future economic benefit from the customer list, it would not have bought it in the first place. Next is the probability of future economic benefit, which is partially met because the probability may be more likely than less likely that the customers of the competitors will now shift to Max Ltd. Lastly is the measurement liability, which is met because the competitor is able to put a price on the customer list, and Max Ltd measurement is based on the purchase price as a historical cost that is reliable. Note that although the probability criteria or the recognition criteria is not fully satisfied, the IAS 38 paragraph 33 still states that if the intangible asset is acquired through separate purchase, then the recognition criteria is always satisfied. So in conclusion, under IAS 38, the purchase customer list actually can be recognized as intangible asset. However, it is not included as non-current asset but as intangible assets. Lastly is the internally generated customer list. So according to the case, the company also plans to add names to the customer list that is obtained, actually met, because Max Ltd initially bought the customer list to expect future economic benefit, which is to attain new customers. However, it is not guaranteed that the prospective customers can actually be attained. Next is the probability of future economic benefit, which is not met because the probability of new prospective customers actually being attained is less likely than more likely. Lastly is the measurement reliability, which is not met because measuring the value of customer cannot be reliable. Note that in IAS 38, paragraph 63, it states that for initial recognition of internally generated brands, mastheads, titles, and lists, including customer lists, cannot be recognized as intangible asset. So in conclusion, the added names to the customer list cannot be recognized as intangible asset, or in other words, it cannot be capitalized.
That is all our presentation regarding expenses. Thank you for your attention and have a good day.